Good afternoon, everybody. The after lunch crowd is here with us. My name is Jesse, and I have 4 fantastic panelists here. We have so much to get through in a very short amount of time. I do want to quickly drop a personal anecdote. As anybody that's talked to me for more than 10 seconds this week will know, I welcomed a baby daughter 3 weeks ago. I probably shouldn't be here this week, so because this is being syndicated on YouTube, I do need to give a shout out to my wife for being very supportive of me being here. And a shout out to my baby girl. Dad will be home tomorrow. With that out of the way, let's get right into it. Earlier this week, we published a report. I published a report in partnership with the Next.io team called Game Changers. We surveyed 68 startups within the industry, many of which are in the audience here. I see you all. And there was some very interesting sentiment coming out of that. And I'd love to just start off today, guys, by getting your perspective. One of the takeaways I've had from this report is that there's this collective sense that the gold rush of the post-PASPA era is over. The low-hanging fruit has been picked. I sensed a little bit of almost frustration and cynicism from some of the startups now that they're really looking to break through. I'd love to start today by getting your perspectives on whether this is actually reality. Is this just some sour grapes, or is there actually some truth to all of this for these entrepreneurs out there? And we'll open it up maybe at the far end with John, if we may.
All right, thank you. I am glad you all are here. We were just talking about, we feel like really the only reason you're here is because Stephen A. Smith will be here later, but I understand. We'll try to make it interesting. I've been in the startup business and gaming for 25 years, but our startups are brick and mortar casinos. Historically, we've been on the buy side of technology. So my first kind of response to that, which I thought your report was excellent, by the way, is I think absolutely there's an opposition to innovation in this industry. It's not necessarily for any malicious reason. But it's a cost, to innovate, to integrate, it involves cost. A casino can put a slot machine down the hall. It'll make $1,000 a day. It'll cost $20,000 for that machine, right? And they've been doing this for a very long time. So it's also a protected industry. So people are motivated by self-interest. They're motivated by profit. And so to step out and try new things or integrate new technology takes time. It takes money. And what I'd say in the gaming industry in the U.S. is that you don't see a lot of innovation on the brick and mortar side. You haven't for 25 years. It really only comes when they have no other choice, which is sort of like how you were when you were a kid and being told to clean your room, right? You put it off as long as possible. So that's my experience.
I would add there's no question in all growth assets there was an inflection upward in level of interest and downward in cost of capital during the pandemic up through 21, and now those trends have very much mean reverted. I think to some extent the frustrations around innovation that John described can be viewed as a feature rather than a bug. If it was really easy to innovate, then there would be no room for the startups. And once a successful B2B startup sells a particular product into a company, it would be easy for them to be unseated. So certainly there are some barriers to entry that actually become quite convenient when you're on the other side of them. I think citing your report, which again really was great, and I think you did an episode with Pierre on the podcast recently that summarized it for those like me who at least initially are too lazy to read. But whether it's sour grapes and moving that term aside, one of the astonishing data points from your survey was that of everyone surveyed, $250 million had been raised, and yet 70% of the companies generated less than $500K in top-line revenue last year, and only 2% of the companies generated more than $500,000 in EBITDA, which means overall there was probably negative EBITDA in 2023. So a $250 million price to negative earnings ratio actually would suggest fundraising perhaps has been quite easy for that group relative to the traction. So I do think it's important to remember 2021 was an aberration. There are standards that I wouldn't even call the new normal because it was sort of the old normal. It was just the pandemic that was the aberration. And when you look at those numbers, which again, your report was fantastic, it does elucidate that there are some very real financial realities that I think some companies do have to confront.
Yeah, I think to add to Lloyd, that cost of capital has flushed out a lot of the not so good companies, but also the not so good investors. I think you've got real quality in the market now. The investors that are putting money to work, they're cautious, but they've seen a lot of businesses over the last 5 or 6 years, and when they put money to work, they're good bets. And the operators that are still operating and have got through this period of tougher financial times, they've done a good job. They've been able to keep afloat, and the new businesses springing up, what we're seeing is quality. And I guess that the easy money, it's not in this market anymore, but it's still in the market overall. The money that's flying around in new markets like Brazil, it's like it's 2019 again here.
The one point I just wanted to add, you mentioned I think some people exhibited some frustration, which is of course quite understandable. For those out raising money now or in the past, when you talk to a really large VC firm, you can often find yourself talking to someone who has never done any fundraising themselves. Maybe they came from banking or consulting and they're great technically, but they had no say in the fundraising of the money that they would be deploying. When you talk to guys like me and Tom, we have raised every single dollar that exists in our funds that then goes into companies. And so we can deeply empathize with the trials and tribulations and challenges of chasing people down for signatures and getting the wire transfers and what it feels like when someone just mysteriously seems to stop answering out of nowhere. I think we can probably empathize a lot more than some founders might expect. And I think you can always find that comfort when you're talking to investors who also did the fundraising themselves for the capital they are deploying.
Yeah, thank you, Jesse. I think I'm a little different here because these are the experts. I have a different silo as a advisor, regulatory affairs, licensing, lobbying, legal work. I want to say 3 things. First of all, master the obvious. I am. Cream always rises to the top. I'm the eternal optimist, and it's not fake. If you survived, because there's startups in this room, last year, you should pat yourself on the back, but don't slow down. Because in order to impress these gentlemen, you want to be tight, and you also want to understand it's not just about, in sports betting particularly, because this is the panel, I guess, for that. We can talk about iGaming, iLottery, the rest. Acquisition is not that relevant anymore. It's always important. Retention is. But differentiation and communicating to your teams, which big companies have a problem doing. Tom knows this, and Lloyd particularly. Communicating your core values, your KPIs, to the rest of your staff so they have goals and objectives. You may only have a handful, a dozen, 2 dozen maybe, but you still need to create that culture of communication. The other point I'd like to make, I think this is going to be a very good year, but it's not going to be a very good year for new money. It's going to be a very good year for those who've already invested in your startup to ask them with a good argument that's succinct and doesn't bore them with the pebbles, how you plan on differentiating from your competitors. Startups are hard. Buckle up. It's not easy. To impress folks like this, you got to really be on your game. And it's not just about, at the end of the day, your profitability now, but how you plan on getting there. Final point, Jesse, if I may. Every startup that I've dealt with early on, okay, they're moving, they have some good technology or offering, they all want to meet with the regulators. Why? What are you going to tell them? What are you going to get from them? If you have something new to offer, 3-factor authentication that the regulators haven't explored, yeah, let's go in. But you don't want to go into the regulators just to kind of grin and shake their hand. You want to have something to offer them because they don't have the time. That's an important piece as another layer, because regulators could be very critical to your ability to scale.
All right. I want to use the rest of our time here to, provide some actionable sort of tactical insight for the founders that are sitting in the room here with us this afternoon. So a couple sort of points I'd love for us to discuss under this umbrella of survival right now, right? This panel is called Surviving Startups. So as far as survival goes in the current environment, let's talk about a couple of topics. One thing I'd love to get some perspective on is, if we accept the premise that the gold rush is over in the U.S. in the post-PASPA era, is it a viable strategy for startups to potentially look at launching their ideas into unregulated markets first as a proof of concept, validate those ideas, and only then reposition those back to regulated markets? How should startups be thinking about that as a potential strategy to circumvent some of this friction that many are encountering in the regulated environment?
I'd love to jump in on that immediately. I think it's a horrible idea. We were just at a lunch with a few regulators. Dave Ribach was one of them. You're operating in unregulated black markets, call it what you want, gray markets. It's going to hurt you in the end. I mean, these operators that are licensed, that these gentlemen have funded, and John, have gone through enormous amounts of capital to be licensed. Now, to be quite candid, I'm all about the regulatory regime, but I don't know why anybody who's in a black market right now would even think about trying to pivot. Because first of all, it takes years, right? You can rehabilitate capital. You can't rehabilitate people. Just ask Isai Scheinberg that question, okay? He had to sell to Amaya because he couldn't get licensed. I don't agree with that strategy. A lot of startups will do that because they think it's an easier pathway forward.
Tom?
Look, I think Bill makes a really good point. I definitely wouldn't be recommending it to anyone. There's been a few successful transitions, and there's definitely money to be made on the dark side. But I think as a starting point, if you can make it in a regulated market and you have the wits about you and have the skill sets, well, you don't need to go to the black or the grey. But I think there's several other ingredients as a founder that you can test in these regulated markets that you can have rather than trying to go. Once you go black,
you don't go back.
That's right.
For us, just based on who our investors and board members are, investing in black market is non-tenable. But I will say I advise all of our portfolio companies on the fact that the unregulated markets tend to be the most fertile ground for innovation. There's just lower barriers to entry to launching new products. And I highly recommend that all industry stakeholders, from the largest operators down to startups, regulated or unregulated, keep an eye on what is gaining traction in the black and gray markets, because often those are really useful indicators of what's to come. Certainly games like crash games, for example, had you been paying attention to the crypto betting sites and unregulated markets, you would not have been surprised at all to see the success of DraftKings Rocket Game. And I think there are many other examples where the aptitude of the unregulated markets to be conducive to entrepreneurship are at least worth taking inspiration from.
Anything to add, John?
A few quick thoughts I would add. First of all, to provide comfort for startup and founder folks out there, the notion of a gaming startup is almost oxymoronic. I say that because, the epicenter of gaming in this country is Nevada, and it's the most antiquated, backwards technological market in the country. The most recent multi-billion-dollar properties that have been built, go check out their sports book. It'll show you where their priorities are. Historically, sports has been an afterthought. Obviously, that changed in 2018. There was a lot of kind of ready, fire, aim that went into it around the euphoria without thinking through the margins. Going back to the metaphor of a slot machine out there that runs 90% margin, literally, you plug it in, it makes that kind of money. Sports betting involves people. We heard yesterday from some of the folks who are changing some of that, the end venues, the micro bets, Cura Sports, and all those kinds of things that are doing it. But like the I don't know his name, but the guy from Dolby yesterday was talking about, sports is an emotional thing. People love it, and they spend a lot of money on it. There is not as much money in that business than there is in others. So what I will start with and say, the idea of a startup, let's just go back and look at where this, from a top-down perspective, where does this business start? Run through who owns the sports betting market in the United States. There's not a single startup in that batch. Anybody says DraftKings was a startup, it was a 7-year DFS company when it showed up. We were involved. My partner was very involved with the acquisition of SB Tech on that deal. They then proceeded, and by the way, Jason Robbins is a fantastic manager. He's probably high-rated genius. But the fact is, they burned through $5 billion of cash. You're not going to have that luxury. They were able to do that because they got in when the euphoria was there. People were thinking it was a Tesla Amazon model, and now it's settling out. People are thinking through, how are we actually going to get profitable in this industry? So the innovation, I think that there's black, there's gray, there's white, and some people say, well, gray is black. So that's for us, we don't want to be dealing as part of our business model with daily letters from attorneys general around the country. That's not really for us. But that's not to say it's illegal. Class 2 was that way before it kind of got sanctioned in the 2007, 2008 timeframe. And a lot of these things probably will ultimately get sanctioned. We did a deal in Arkansas in 2019, effectively turned a gray market legit. It allowed them to invest billions of dollars of capital in that state once that market really went fully, legit, if you will, not gray any longer. So if you're able to get out, and that I was curious with the question, is it because I think we naturally go to, we should try it out on the gray market. And I don't know if there's a way to deploy your technology in a market that's unrelated, then you bring it in. Last thing I'll say is, who knows with Apple Sports? Who knows with Google? Right? If you ask me, and you look at the profitability, the smallest casino in North Dakota made more money last night than DraftKings has ever made. Think about that, right? What's the future? I think they're going to get profitable. I think they're going to finally get that scale. But I think the biggest markets coming down the pike, Nevada, they want them out. They don't want new technology. They got investment brick and mortar. California, the same way. That's coming down the pike. So what's the future? I could very easily see an Apple coming in and acquiring DraftKings, because what are they ultimately? They're a data company, right? They own a very, very valuable demographic. I'll stop there.
All right, 2 other survival tactics I want us to do our best to get through here with the short amount of time we have left. I want to talk briefly about the pivot, right? It's a much fabled thing that gets talked about. What I really want to understand, though, is from each of your guys' perspectives, right? As startups are out there, wandering through the forest, finding their way, when is the right time for them to abandon plan A and sort of recast their direction in pursuit of product market fit? How should they be thinking about that, particularly in the current environment, particularly for those that have raised capital in more friendly terms a couple of years ago that might have a hard time extending their runway now in the current environment? Tom, do you want to kick that one off?
We like businesses where revenue leads costs. They don't need us for money. They're able to grow revenues significantly. So if they can't grow revenues at least above market rate, they need to pivot. And also they've had time in the market. They're not a flash in the pan type business. They're actually proven operators. They've got that work ethic, focus, and time builds credibility. So if they've got those ingredients, we really look at them and a nimble, agile team that's committed. Having that type of founder or group of people that are all in is probably the biggest thing that we want to. We don't want someone that's doing something part of 10 things they're doing. If they're passionate about being in business, giving their life to it, and have that discipline around costs, and they're going to make it. They're the type of people we want to be involved with.
100%. Lloyd, do you want to add on to that?
Yeah, I think Tom makes all really strong points. I think assuming you are a young and nimble and agile enough startup.
That was his wallet.
Yeah, to technologically handle the capabilities of pivoting without accruing too much technical debt and all that. I think the most important asset to consider as a founder is the relationship and social capital that you need to draw down on when you go back to your investors, other commercial stakeholders you have pitched in the past, advisors, et cetera, and say, we're not doing this anymore, we're doing that now. I think the first time you do it, any decent investor or operator is infinitely open, and there's no negative connotation whatsoever, perhaps. Startups move fast and break things, they iterate. But once you start pivoting, perhaps for the second time, and certainly beyond that, I think you run out of the social and reputational capital to continue doing so. So my answer to how and when should startups consider the pivot, I think, is just very intentionally and deliberately, and then perhaps following some of what Tom just mentioned.
I'll be brief. I would just say, I'm not even sure what that means. You should always be contingency planning. What are you going to do if this doesn't work? But if you're a technology-centric company that is created around a specific idea, moving away from that idea raises a whole other set of questions. So I think it's if you've got 5 wonderful ideas and you can pivot, and that's something that works. But I think ultimately you're going to be facing the skepticism of your investors and others anytime you sort of say, hey, let's move to plan B, and why do we think that's going to work? But I would defer to the others and say that's a fact and circumstances evaluation.
Excellent. And then the final thing I want to talk about, guys, as a third survival tactic is M&A and consolidation in general, and particularly at the earlier stage. And look, the report that we've referenced here today talked a lot about that, right? There's a lot of anticipation that this year will bring consolidation, and particularly at the earlier stages. What I'm curious to get this perspective on is, when, how should companies think about exit opportunities vis-a-vis continuing to go it alone and pursue the growth of enterprise valuation? And again, that inflection point that they will have, like, how should they think about that decision, and what are sort of the markers on the road that should help influence that decision? Bill, do we want to maybe start with you on this one?
Sure. Tom, I think hit the nail on the head in terms of being nimble and being flexible, and realizing when you've perhaps made a mistake, right? It's time to move quickly, and then going back into your boardroom, so-and-so, or your investors, and explaining to them, when market conditions change, if you're still going down the road of your initial offering, and those conditions aren't really conducive to that, you've got to realize you made a mistake. The market's changed. What I find very encouraging is the number of startups here, and I promised Rory and Pierre and the Next IO folks, coming to conferences is important to meet veterans who can advise, but it's also important because I would never want to pitch to Tom Waterhouse or Lloyd or John on a Zoom for something where I really need support. I want to see them in person. And that relationship building doesn't happen in one meeting. It doesn't happen in one conference. And that's why we're fortunate to be able to come together so these gentlemen have opportunities and the startups have opportunities to be considered.
To answer your question about maybe creative M&A, Jesse, I do think all founders, especially that maybe haven't quite hit their stride and are struggling to raise funding, should think about creative forms of M&A that maybe give you a little bit of stock and upside in the new entity and live to fight another day. I think founders are exactly the type of people that don't want to take a back seat to anyone unless there's a gigantic payout involved, and so there's an inherent tension there. But I do think there are probably quite a few companies today that have a likelihood of survival that is tending towards zero, and so with some creative M&A, even two relatively small companies combining forces, acquiring the tech or a team in an acqui-hire and giving some additional upside. And then finally, and you mentioned this so astutely in your report, I do think there is validity. If you're a first-time founder and you can get a win on the board and a press release that the company you founded got acquired and that, funding details are not being released at this time, you're going to have a much easier time raising, the next time you have an idea, and I do think it's worthwhile.
To that point, you often see founders and they're in this new market, and US was like this a few years ago. If you get the money for an idea that actually you haven't done anything, take it. And that's sort of one example. And then there's another example where you actually haven't got the skill sets internally to be able to grow the business. And it's that struggle for cash. I need these people. I need to grow. Well, then you want to find money, preferably smart money, someone that can add more than just money. And then the third time is if you're making money hand over fist and you can pay for those skill sets rather than getting equity in, well, then pay for the skill sets. They're sort of three different types of businesses we've seen over the last few years. And it just depends the timing and where you are as a business.
Last word, John.
Last word. I'm gonna tie it up by echoing their comments. First of all, number one, you get the money. Somebody offers you money, take it. Basically, you'll need it. So your bias should be that. And then I think echoing Lloyd here, 100%, especially in a regulated environment. I think there's a lot, and I was just talking to some folks yesterday. I think there's a lot of misunderstanding about what it means to be working in a regulated environment. You are a partner, in effect, either directly or indirectly, with a governmental entity, if you think about it. It is a protected industry. Nothing happens in the regulated market without a sanction from someone that necessarily adds time to anything that you're planning to do. And the fact is, and this is why, I'd say a lot of startups end up dying, and then even the ones that make it don't ever get profitable. They get purchased. Why? Because an incumbent has a built-in advantage and has the ability possibly to deploy your technology better than you can, faster. And so I would say every single day you should be thinking about shareholder value, yourself, your family, your employees, and think about how do you get your technology, if it's great, deployed quicker. And as Lloyd said, you make that happen and it works out for folks, people are going to be more inclined to work with you the next time down the road.
All right, that's time. Thank you all for joining today. Thank you to our panelists.